You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. All right, well, happy Halloween to everybody out there. We are taping Options Playbook Radio on Wednesday, October 31st. The markets are open right now. It's around noon Eastern time, and we're going to look at a trade in a stock that's about to announce earnings, NVDA Corporation. We had that stock featured in our midday market call, which Michael Kahn, who used to be a Barron's columnist and is a chartered market technician, decided that maybe it's time for a dead cat bounce in NVIDIA. And it's just a very interesting underlying. The stock has been all over the place. It's, in general, like the markets, but the swings to the downside, the swings to the upside have even been greater than the general market overall. The stock at one point in time was at around 290. At the low end, it got, over the last month, it came all the way crashing down, all the way down to about 160. And so the stock has just been all over the place. And when you have a higher price stock that's had just some general volatility, not because of earnings, but because of just market volatility, it just makes it an interesting underlying to figure out option strategies in. So that's going to be our stock for today. As of right now, and I just froze the market, NVIDIA Corporation symbol, N as in Nancy, V as in Victor, D as in David, A as in Alpha, is trading at 206.97. It's up $3.97 on the day. And that's after a big update yesterday. It came up about 10 points too. Like I said, the bottom number over the last, I'd say 2 weeks was down around 185.60, somewhere in that range, 186. And so we've already had a little bit of a bounce back up. And NVIDIA is going to be announcing earnings on the 15th of November. And as always on Options Playbook Radio, we like to just talk about scenarios where different strategies might work. Nothing's ever meant to be a recommendation. So I'm going to throw two strategies at you today. They're going to be the same strategy. They're just going to be in different time periods, different expirations. And I'm going to explain about I'm going to take this opportunity to look at the nuances of these two trades. We're going to be doing them basically for the same credit to the account to try to compare apples to apples. But there's one of the trades is going to contain their earnings. It's going to have the expiration that has the earnings date in it. And the other one will not contain their earnings. And I think in a stock like NVIDIA with the volatilities actually at all-time highs, even when you consider no earnings, no major news event. NVIDIA right now, the 30-day implied volatility is really at its all-time high if you take out a lot of the major news events that were around. So just in general, we got huge volatility in it. So if I look at the NVIDIA option chain and I look at the expirations that are available, the two ones we're going to focus on are the November 9th expiration and the November 16th expiration. Now, don't forget that today is Halloween. It is the 31st of October. So we're going to look at those two expirations because one contains earnings and one does not. So I think it's important to mention that the implied volatility on the November 9th expiration for the most at the money call and put, basically the average there is about 69% implied volatility, which is still on the high end of the range overall, and that does not contain the earnings. We do have other major companies. Some of the FANG stocks are coming out with earnings at the beginning of November, those type of things that can affect NVIDIA in some way, shape, and form just because it's in the tech industry. And then the November 16th expiration is at 86% implied volatility, but basically a weighted average between the call and put most at the money option contract. So we have quite a bit of difference, but both option contracts have extremely high volatility. Now, if I look at this, and knowing that the last couple of days, the stock has actually made about a 25-point move to the upside, just overall, our expectations of implied volatility would be that as we approach earnings, the at-the-money implied vol would actually increase from its current range right now. And the at-the-money implied vol on the month on November 9th expiration, the shorter term expiration, would most likely decrease overall. Now, that's just that's just the norm. As you approach earnings, the shorter term months implied volatilities come down, time decays, and the longer term months which contain earnings have a tendency to increase. Now, that's not a guarantee by any means. That's just a normal market observation. So 87% is where that implied volatility is at, and that's going to weigh heavily in our two strategies. So I want to compare apples to apples and actually have a discussion about these trades. So I went out and said, okay, I don't know much about NVIDIA, and it's been all over the place. There's no analyst in this world that could ever predict the type of move that NVIDIA has had over the last month. And so I'm going to say that that volatility continues. And I do not like long straddles overall, especially when the premium or the implied volatility has already been jacked up and it continues to remain high. So I'm going to look at doing a backspread, and you can do it to the put side. You can do it to the call side. I'm going to choose the call side. The market trend has been up. So in general, I'm going to do the call side. There's no other rationale besides I needed to pick a direction. So on a backspread with calls, what we are doing is we are selling an in-the-money option contract, an expensive option contract, and trying to pay for two at-the-money option contracts. Now, we want to get this trade done for a net credit to the account. And the concept is if you do this trade, you are looking for a volatile market. If the market continues on up at this type of pace, that's a good thing because you are long one more call than you are short. If the market goes down, you did it for a net credit. So as long as it goes down below the strike that you sold, well, then you can receive the net credit because all the option contracts would expire worthless, and you make the small credit and you just go on to the next trade. Where's the risk? It doesn't move at all. So if the stock just stays where it's at and it settles down, that is your biggest risk on this trade. So right now, as I said, we're taping. It was live, but I stopped the market. We're around noonish on the 31st of October. The last trade on the video was 206.97, and it was up $3.97. On the shorter term expiration, implied volatilities are lower, which implies a smaller move over that time frame, and that's mainly because of earnings. So we are able to do a shorter width spread looking for less of a move overall for this trade to be profitable. Okay, so let's start with the shortest term expiration, the November 9th expiration. So our trade would be, we're going to sell one deep in the money call, the 190 strike on the November 9th expiration. That is trading, just so you know, 2055 by 2105 right now. We are then going to use that credit to try to pay for two at the money option contracts, the 205 calls, that is trading 1015 by 1045. So there's a little bit of a juice in these bid-ask spreads. And the midpoint of this option trade right now, of this option strategy, is a credit of 20 cents to the account. Now, sometimes a backspread is referred to as a pay later call in this instance, in that if you do this trade, your risk is the width between the spread, which is 190 to 205, or 15 points. And the only way that you can lose that entire 15 points is if the stock stays right at 205 and it expires there, right at expiration. But on the November 9th expiration, we have 9 days remaining until that expiration date. So if this move doesn't happen over the next 4 or 5 days, I'm not going to just hang around and say, oh, gee, I hope it doesn't land on the strike. I'm going to get out of the trade. There's a lot of premium in this underlying, even though we're not in the earnings date. You're just going to get out of the trade. It's a 4 or 5 day trade, and you're done and you're out. Okay, so the move that we're looking for is we want it to go either below 190 on the downside, or we want it to go 15 points above 205 on the upside. That's really what we're looking for. So there's a 30-point range that we really want the stock to make. We want it to make that type of move. And if you don't think it can move that much, then you don't do the trade. Now, on the upside, if it moves 15 points, it basically covers the credit spread that we use to help pay for the extra call option. So if we get any move to the upside, well, then that's a complete home run, because we are long one extra call in this scenario. So if it goes 15, 20, 25, 30, 35, 40 points, well, that's awesome on the upside, because we got that extra call option, and it will more than make up for the short call spread that we sold to help pay for that extra call option. On the downside, we really need it to go down below 190. Why? Because then all the options will expire worthless, and we're hoping to get this done at a midpoint credit of 20 cents. So that's a 15-point wide spread. Now, here's the reason why I chose this strategy, in that they're announcing earnings on the 15th, and there's a November 16th option contract. So if you look at that November 16th expiration and you try to set up a trade where you can bring in a net credit, guess what? You got to go wider. Why? Implied volatilities are bigger. They're implying a bigger move. So because the potential for this thing to skyrocket is higher, then you have to pay for that. So what I had to do was actually go out 25 points, which is about the expected move around earnings. That's what the long straddle is trading for, fairly close to that. And I had to sell the 180 call as opposed to the 190 and buy the 205 call. So we're still buying the same at the money call option, but we had to go deeper in the money to pay for two of them. So the 180 call is trading for 33.55 on the ask by 33.05 on the bid. And the one that we're buying is 16.30 on the bid and 16.80 on the ask. So the net credit, the midpoint, is also 20 cents. So at this point in time, when I took these screenshots, these trades were at the exact same midpoint net credit to the account, but they're much different trades. So which one would we do? Would we want to do the shorter term one that looks for a lot less of a move, a 15-point move, in order to really be profitable on that trade? Or do you want to go out to the earnings scenario and look at the 25-point move in order to really be profitable on that trade? And the biggest question, well, there's obviously, I don't have a crystal ball to know which one is better. You tell me the move, and when it happens, I can tell you which one's going to be better. But since we don't have that information, we have to take what's in front of us and try to make a logical decision as to which one we would like to do. Now, the biggest point here and the biggest thing that we have to decide is not necessarily how big of a move we're thinking of NVIDIA Corporation. We need to think about the timing of the move. If we think it's going to take a little bit longer for this stock to actually make the type of volatile move that we're looking at, we have a short-term strategy here with a November 9th expiration where we expect implied volatilities to come in. Versus we have a longer term expiration where we expect implied volatilities to increase. And if you're doing this trade, you're making just as much of a forecast on implied volatility as you are on the move of the underlying stock. So if I buy the longer term one, I have more at risk because I have a wider width between the strikes. But I have less at risk if I'm talking about implied volatility because I think it's going to increase. And if the market does make a 15-point move, I still expect the longer term trade to be profitable if you throw in the bang to the buck as far as implied volatility. So if you think that implied volatility is going to increase and you make a 15-point move, I think both spreads would be profitable. Now, if it makes that move quicker, I'd rather be in the short-term one, of course, and that's pretty much hindsight is 20/20 in that scenario. But in a weird way, that earnings report gives you a small buffer on the longer-term trade. So you have to put up more money, which is a big deal because that money is true risk. You have a true short call spread that is paying for an extra call in this situation, and you need to have that capital up. So I don't know the answer, but my point here is that if you do use the expiration that needs a bigger move and contains that earnings report, you have a bigger buffer to help you out if you are incorrect in this forecast and this stock doesn't move at all. What's that buffer? An increase in implied volatility. So in some ways, you can say that the November 16th expiration is quote unquote, I'm using air quotes here, less riskier overall than the November 9th expiration, only because you're hoping that the implied volatility increase is enough of a buffer to offset your forecast if the stock doesn't move at all. Now, the other thing about the November 16th expiration is you don't have to wait around till earnings. You can get out prior to it. You can take the same type of forecast and say, gee, if this thing doesn't move in 5 days, I'm going to get out of this trade. And that is a very viable strategy. As a matter of fact, I think I would take that approach in this scenario. But you also have the option to stick around until that earnings report. And if that earnings report comes out, there's a great chance it's going to move. But that implied volatility crunch can come back in, and all the benefits of that we just talked about as far as implied volatility is going to be the exact opposite if you wait until earnings. All right. That's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, please email me at theoptionsguy@invest.ally.com. That's theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.